Hello guys, my name is Bala. Welcome to part 3 of this presentation series in securities lending. If you haven't watched the first two videos, please watch them first. It'll help you understand the contents of this presentation better. In this presentation, we're going to look at the basics of collateral management, the different types of collateral exchanged in securities lending, some examples of the economics, and the basics of collateral allocation and optimization. Let's use the example from our previous video. A client wants to borrow 1,000 shares of Apple and reaches out to a broker. The market value of 1,000 shares of Apple is US 500,000, and the collateral value, including a 5% margin, is $525,000. Like I mentioned in the previous video, the borrower is expected to put up additional collateral to protect the lender against sudden price movements. In this particular example, it's 5%. The borrower has two options. Either they can give cash as collateral or securities as collateral. This is usually pre-agreed before the borrower and the lender enter into a contract. Let's first look at what happens when cash is used as collateral. A client enters into a contract with a broker and provides cash as collateral. It could be in dollars, in euros, in sterling, or any major currency that is acceptable as collateral. The broker would then typically invest this cash with an institution that is considered to be safe and liquid. This could be the central bank in that local country. This central bank would then pay an interest on this cash that is deposited based on a standard benchmark. It could be EONIA for euros, LIBOR for sterling, or Fed funds for dollars, or any standard benchmark. The interest that is received by the broker is then usually passed back to the client. To clarify, this behavior is not specific to securities lending. You will see this behavior across other financial products as well when cash is used as collateral. Going back to our previous example, let's assume the client has agreed to borrow 1,000 shares of Apple from the broker, for which he's agreed to put up $525,000 as collateral. Let's assume the interest rate on US dollar deposits is 15 basis points or 0.15%. In addition to this, a client is also expected to pay a borrow fee for borrowing the specific stock, which in this case works out to be 7% for Apple. So if a client wanted to borrow a different stock, let's say Facebook, it would be a different borrow fee. It is important to understand the difference between these two components because interest rate is specific to the currency being exchanged or the currency of the collateral being exchanged, whereas the borrow fee is specific to the stock being borrowed. The net rebate works out to be negative 6.85%, which is the difference between the interest received on cash less any borrow fees to be paid for borrowing the stock. Cash collateral is also exchanged on a daily basis. This is done on the back of a process known as mark to market. Let's assume the price of Apple increases from $500 to $510 per share. As a result, the collateral that is needed for this contract also goes up. This results in the collateral being exchanged between the borrower and the lender on a daily basis due to movements in the stock price. As a result, the interest payment also changes based on the total amount of collateral being exchanged on a daily basis. Let's look at the economics of the same trade when non-cash collateral is used. The collateral value still remains the same as $525,000, and the borrow fee for Apple also remains the same as 7%. The only difference is instead of using cash as collateral, the borrower now provides securities as collateral. This could include treasury bills, corporate bonds, equity stocks, and other forms of securities as collateral. And this is usually pre-agreed between the borrower and the lender, and the maximum percentage of each type of collateral is also pre-agreed. If the borrower goes bankrupt, the lender will have the rights to sell this collateral and recover his losses. Like cash collateral, non-cash collateral is also exchanged on a daily basis to account for movements in the stock price. The expense to the client or the borrower of Apple in this example is 7% plus any other expense in sourcing the collateral. Let's look at some objectives of collateral management. Collateral management and securities lending, they both go hand in hand. Both are broad and diverse business areas, so it's not easy to quantify the objectives on a single slide. But at a high level, as a collateral manager, one needs to understand the exposure to a counterparty. Am I giving too much collateral than what is actually needed? Should I bring back the collateral that I have already given? Am I borrowing too much from a single counterparty? Should I diversify and minimize my counterparty risk? Do I have an FX exposure? So for example, you could be borrowing Toyota, which is a Japanese stock, but giving collateral in a different currency like US dollars or euros. So you have an FX risk between Japanese yen and the collateral that is being pledged. Also, as a collateral manager, can I allocate my available collateral in a more optimal way? We will be talking about this in the next slide. And as a collateral manager, one needs to constantly negotiate the collateral schedules with every counterparty. This way, you might be able to give a more diversified portfolio of collateral to a counterparty. And most importantly, as a collateral manager, you need to understand and manage your liquidity situation prudently. Let's use the Apple contract as an example. Assuming as a broker you've lent 1,000 shares of Apple to some client on an overnight basis. What this means is the client can terminate the contract on an overnight basis or with a one-day notice. And let's assume as a collateral manager you've reinvested that cash collateral that you've received from the client on a 3-month basis, which means you've locked that cash collateral with someone for 3 months. If for some reason the client wishes to close the contract, you are forced to return the cash collateral within a day. However, since the cash collateral is locked for a period of 3 months, you've got a liquidity problem. So as a collateral manager, you need to understand and manage this liquidity situation prudently. Now let's look at how collateral allocation and optimization works. Let's assume Bank A has borrowed $100 million worth of securities from Bank B and also from Bank C. And Bank A has agreed to give securities as collateral to both Bank B and C. Bank B accepts only the following types of collateral: US Treasury bills, US S&P 500 equities, and a maximum of 30% of those equities, and AAA or AAA plus bonds, and a maximum of 20%. Bank C, on the other hand, accepts a slightly more diversified portfolio of US Treasury bills, US and UK equities, and BBB bonds or higher. The percentage is also slightly different. One thing to note is Bank A, when it sources this collateral, it does not come free of cost. It has to pay someone to buy or borrow these collateral. This could be from an internal desk, or Bank A might be forced to go to a third party to source this collateral. Either ways, Bank A has to pay someone. Generally, T-bills are the most expensive and BBB bonds are the cheapest. So Bank A has to borrow a combination of all these different types of collateral to manage its exposure with Bank B and Bank C. Like I mentioned, based on the securities that have been borrowed, the exposure changes on a daily basis because of changes in the price of the underlying instruments. Collateral allocation is the process of allocating sufficient collateral to various lenders, in this case Bank B and Bank C, to meet their daily exposure. Whereas collateral optimization is a process of allocating the cheapest collateral without violating the agreed collateral schedule to a particular lender and be economically efficient. The keyword here is to be economically efficient. Bank A could have actually given treasury bills as collateral to both Bank B and Bank C. They are considered to be the safest form of collateral and hence they are the most expensive as well. So from an allocation standpoint, Bank A would have spent a lot of money in sourcing these treasury bills and would have allocated the collateral to both Bank B and C. However, from an economic standpoint, that's not the most optimal allocation of collateral. Hence, it's important to understand the difference between allocation versus optimization. Let's look at a simple example to understand how collateral obligations are managed on a daily basis. In this example, I've assumed 3 stocks have been borrowed, all versus cash collateral. On day 1, the total collateral requirement is $1 million. So the borrower transfers $1 million to the lender. On day 2, the borrower has returned 360 shares of Tesla. As a result, the net collateral requirement has dropped to $900,000. Since the borrower has put up more collateral, the difference is returned by the lender. So in this case, the lender has to return $100,000 back to the borrower. On day 3, there is no change in the stock positions. The prices have changed a little bit, but across all the stocks borrowed, the total collateral value hasn't changed. So there is no requirement to exchange any collateral between the borrower and lender between day 2 and day 3. The purpose of this example is to show you at a very high level how collateral obligations are managed on a daily basis. However, in reality, this is a lot more complex, especially when you have a number of counterparties and different currencies being exchanged every single day. Now let's look at a simple example to understand how non-cash collateral obligations are managed. Let's use the example from our previous slide. However, instead of cash, the borrower has agreed to give securities as collateral. The table on the right shows the agreed collateral schedule between the borrower and the lender. If you notice, there is a component called as a haircut. The haircut is actually an indication of the quality of the collateral seen from a lender's perspective. The haircut is actually applied to the market value or the theoretical value of the collateral provided to calculate the perceived value of the collateral from a lender's perspective. The haircut also gives you an indication of how liquid that instrument is. Treasury bills, UK gilts, and other sovereign bonds are usually considered to be risk-free instruments, so they carry a very low haircut. In addition to the haircut, there is also a maximum allowed percentage. This indicates the maximum percentage of a particular type of collateral that a lender is willing to accept. So in this particular example, even though UK and French equities carry the same haircut, the lender is not willing to take more than 15% of French equities. So I really hope this presentation has given you a better understanding of collateral in securities lending, the role of cash and non-cash collateral, and how they are managed on a daily basis. So if you have any questions, please reach out to me at stock.borrow.loan@gmail.com. Thank you.